Welcome to the Transparent FX Academy. I'm Nick, and I'm a top author on TradingView with over 190k reputation points. In this video, I will be speaking about NZDUSD. Now, as usual, to keep the video as educational as possible, first I will be covering the technical aspect for this market. Then we will be moving to the order flow by looking at the commitment of traders, so the COT data, which is essentially what hedge funds and the big players in the market are doing and how they're shifting their orders and moving their positions. And by the end of the video, by using a combination of these two different types of analysis, we will try to understand where we have the highest probabilities for the next potential move here for this pair. So this is definitely a video you do not want to miss. If you're new to the channel, make sure to subscribe. This is the place to be for high quality, free trading education. Now, without further ado, let's jump straight onto the charts. Now, starting here from the monthly time frame, what we can see is that at the moment we have a market which is testing a quite strong historical monthly demand and support area. From here, in fact, all this previous rejection to the upside was created again here, and again here. And what we can see is that at the moment the market is testing and rejecting to the upside once again this exact same zone. So in a situation like this, there is definitely the possibility of seeing more bullish price action being created, as already happened in the past when the market was testing and rejecting this exact same level. We can also notice, if we look closer, that we just had a quite important break of structure. This zone, in fact, was acting as previous monthly resistance from which all this move to the downside was created, which currently is acting as support. Now, as the market is testing this previous resistance to turn support, there is definitely the possibility of seeing a potential rejection to the upside being created away from this zone. We can also notice, if we look closer, that the pattern that the market has created now is a very clear impulse followed by a correction. Now, in general, after an impulse, if you want to measure the correction, you have to take your Fibonacci from the low to the high of the impulse leg. And if we do that, we can see how we have the 0.32, 50% and 0.618 Fibonacci retracements, all lining up exactly with this previous resistance turn support. Now, this creates confluence of support inside of this zone because we have all these levels lining up in the same area of price. And when we have a confluence of support zone, we have an increased probability of seeing institutional longing inside of this area. And institutional longing is something that we will be speaking about in just a few moments when we move to the commitment of traders analysis. For now, let's keep all of this in mind and drop down on the weekly time frame. Now, from a weekly perspective, what we can notice is that at the moment, the market is testing a strong demand and support area also from a weekly standpoint. In fact, we can notice that this wick here is exactly the low from which all this rejection to the upside started. And at the moment, the market is testing the exact same level. So there is the possibility that, again, buyers might enter this market exactly this zone, as already happened in the past. So this increases the probabilities of a potential rejection to the upside away from this area. Dropping down on the daily time frame, what do we see? Now, from a daily perspective, first of all, it is even more clear that we're testing exactly the previous level of support, but we can also notice that in creating this move to the downside, the market has also printed this daily M pattern. Now, specifically in this case, overextended M pattern. Now, after the creation of an overextended M pattern, what you would expect is for the market to create a rejection to the upside, to go and retrace at least to the 0.32 of the Fibonacci taken on the impulse leg. This is a pattern that the market likes to create over and over again. In my experience, for example, we can see already one here. The market created this overextended M pattern, got rejected to the upside. We can see again here, this M pattern here, after which the market completed a pattern at the neckline. So it's not every time, but when there is such pattern, in my experience, there is an increased probability of seeing a potential rejection to the upside. So before we dig deeper into what we have here from a technical perspective, first, let's go and see what we have when it comes to the commitment of traders. So what the big players in the market are doing precisely on the NZD. Now, what we can see here is that with the last reports, net positions have been massively increased. We went from having minus 16.7k net positions, so a negative net positioning with more shorts than longs, 36.5k shorts compared to only 19.8k longs, all the way up to now having a positive net positioning of plus 1.9k net positions with more longs than shorts. 29.1k longs compared to only 27.1k shorts, with 2.6k longs added just with the last report and 700 shorts getting closed. So institutions have been moving aggressively to the bullish side for NZDUSD, therefore making it stronger. So let's keep all of this in mind and move back to the chart. And by the way, if you still haven't, make sure that you join my free Telegram channel, which you find linked in description, so you never miss new updates. Now back to the analysis. So in a situation like this, as we were saying, we are testing strong demand and support. Institutions are already moving to the bullish side for NZDUSD. So there's an increased probability of seeing more institutional longing, which could further increase the probabilities of a potential rejection to the upside away from this level. So in a situation like this, what would I expect? Well, as usual, trading is reactive and not predictive. The monthly, weekly, and daily timeframes combined with the COT data, those are the best timeframes when it comes to the directional aspect of the market. However, when it comes to identifying early shifts in the trend of a market, the best timeframes for that are the intraday timeframes, so 4 hour and lower. Therefore, what I would expect is that if this market would shift from an intraday bearish to a bullish market, at that point, I wouldn't be surprised to see a potential rejection to the upside away from this level for the market to retrace at least to the 0.32 of the Fibonacci taken on the impulse leg. That move definitely wouldn't surprise me. Now, if you want to learn more, I really suggest that you go and check out the transparentfxtrading.com website, which you find linked in description. Here, you have the possibility to gain access to the most complete mentorship program ever that I have created. You have the possibility to gain access to all the courses, the trading station software with the Telegram signals integration, one-on-one private mentoring directly with me, the COT data software that you see me use in all these videos. And if you continue to scroll down the website, past the testimonials, you will see that you have the possibility to join and gain automatically access with the email and password that you will create during the sign-up process. So I really suggest that you go and check it out. The link is in description and I will see you in it. If you enjoyed the video, make sure to drop a like and also let me know in the comments below any new pairs or topics that you would like me to cover in the next videos. And I will see you in my next breakdown.